Today, the inflation problem. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. Well, stocks finished with sharp losses in the US on Thursday, dropping after the January Consumer Price Index showed a much hotter than expected 7.5% year-over-year jump. And equities took another leg lower in afternoon trade after St. Louis Federal Reserve Bank President James Bullard told Bloomberg that he would like to see the central bank deliver 100 basis points or 1 percentage points worth of rate increases over the next 3 meetings. As a result, the Dow Jones Industrial Average dropped 1.47% to close near 35,242, while the S&P 500 fell 1.89% to close near 4,504, and the Nasdaq Composite tumbled 2.1%, ending near 14,186. More significantly, the Treasury Yield shot higher, with the 10-year up 5.67% to 2.036. That's crossed the 2% level for the first time since 2019. The 2-year rate was up 18.62% to 1.599. So the markets think rates are going to go higher faster. Now, looking at this inflation information in more detail, US inflation hit a 40-year high in January after food, electricity, and shelter drove a bigger than expected rise in the Consumer Price Index and pushed financial markets to price in a higher chance that the Federal Reserve will hike rates by 0.5% in just over a fortnight. Excluding the volatile food and energy components, the so-called core prices increased 6% from a year ago. That's the most since 1982 and up 0.6% from a month earlier. The overall Consumer Price Index climbed 7.5% from a year earlier, following a 7% annual gain in December. That's according to the Labour Department data. Economists had expected the annual figure of 7.3%, so it exceeded their expectations. And in January, inflation rose 0.6% from a month earlier. That's ahead of the 0.4% expected by economists. The food index rose 0.9% in January, following a 0.5% increase in December, and now shows an annual inflation reading of 7.1%. That's the highest in 41 years. Household furnishings and operations increased 1.3% in January, following a 1.1% increase in December. So that index is now 9.6% higher than a year ago, and it's grown in the fastest pace for 47 years. The energy index increased 0.9% from a month earlier, driven by a 4.2% spike in electricity during January. That index is up 27%. Yes, 27% over the last 12 months. Used cars and trucks continued their climb, up 1.5% in the month and up 40.5% for the year, as the semiconductor shortage continues to bite new car production and have knock-on effects on used cars. Medical care surged 0.9% in January after showing no increase in December, while shelter costs added 0.3% in the month, pushing annual cost to 4.4%. And apparel costs jumped 1.1% in the month, and they're up 5% in the year. Now, if you exclude the volatile food and energy components, that so-called core prices, then it increased 6% from a year ago. And that's the most since 1982, up 0.6% for the month. Now, that surprise increase had futures markets increase the odds of a 50 basis point increase in the official Fed funds rate at the March meeting of the bank, up more than 50%. And Fed board member James Bullard said that the inflation problem meant the central bank needed to consider an inter-meeting increase and suggested 100 basis points worth of hikes was required by the 1st of July. The run-up in prices has eroded wage gains of 5.7% over the last year and diminished the purchasing power of households in a surging economic recovery. In fact, on Thursday, the White House released a statement calling this week Prices Week and outlined what it called a comprehensive strategy to lower costs for working families. President Joe Biden said on Thursday that his administration would be all hands to the deck to win this fight. On higher prices, we have been using every tool at our disposal, and while today is a reminder that Americans' budgets are being stretched in ways that create real stress at the kitchen table, there are also signs that we will make it through this challenge, Mr. Biden said. Republican Senate leader Mitch McConnell jumped on the news, saying if people had not received a pay rise of 8%, then Democrats' policies had given them a pay cut. The data confirms what working families already know painfully well. Rampant inflation and soaring prices are crushing the American people, Mr. McConnell said. The data reinforces the Fed's intentions to begin rising rates next month, and it's already changed those market expectations. Deutsche Bank's chief US economist, Matthew Lutze, changed his view on the March Fed rate hike following the figures. This morning's CPI data, which rose more than expected, with outperformance driven by persistent items like rent and medical services, has turned that risk scenario into a baseline, he said. With inflation pressures showing signs of accelerating in the near term, we now anticipate that the Fed will undertake a 50 basis point hike in March to kick off the tightening cycle. He joined others, such as Numera, who called a 50 basis point rate hike in March back in January. Bank of America's Alexander Lin has forecast 7 0.25% percentage point rate hikes this year due to inflation. For the Fed, this report provides another wake-up call. Inflation is here and it continues to make its presence known everywhere, he said. We remain comfortable with our hawkish call for the Fed to hike 7 times this year, beginning at the next FOMC meeting in March. Leading up to that Fed March meeting on the 15th and 16th of March, the central bank's board will also have to hand the February CPI report. A tight labour market in which the unemployment rate is now 4% has led employers to bid up wages in an attempt to fill millions of job openings and to retain workers. JP Morgan's David Kelly warned that a pickup in services inflation is worrisome if it suggests pass-through of higher wages costs to consumers. So US stocks extended their declines after the Federal Reserve Bank of St. Louis President James Bullard said that he supported raising rates by a full percentage point by July. And of course, Treasury yields climbed further. Bullard's plan actually involves spreading the increase over 3 meetings, shrinking the Fed's balance sheet starting in the second quarter, and then deciding on the path of rates in the second half based on updated data. And he said he was undecided on whether the March meeting should begin with 50 basis points and raise the possibility of the Fed at some point considering a move between scheduled meetings. There is a difference between what any one FOMC participant says and what the committee does, said Chris Lowe, chief economist at FHN Financial. But the odds of a 50 basis point hike in March or May are higher if the market expects it. Bullard is well aware of this and likely intended to push the Fed funds futures market to reprice in support of the urgency he feels after this morning's CPI report. If he can make us think it, the Fed is much more likely to do it. Overnight index swaps priced 85% odds of a 50 basis point uplift in March, with an additional 25 basis points priced in for May and June. Just under 6.5 quarter point moves were priced into the December Fed meeting. The data reinforces the Fed's intentions to begin raising rates next month to combat this broad-based inflationary pressure, and it could lead markets to expect even more aggressive action from the central bank. The steady run-up in prices has eroded recent wages gains and diminished American families' purchasing power, sucking much of the air out of what has been an exceptional bounce back in the US economy. The rapid pickup in inflation boils down in large to the mismatch between supply and demand. With the help of massive government stimulus, a surge in household purchases strained factories and global supply chains. Capacity constraints of US producers trying to ramp up production were made worse by a smaller pool of available labour. The tight labour market, in which the unemployment rate is now 4%, has led employers to bid up wages in an attempt to fill millions of job openings and to retain workers. Last year, compensation costs surged by the most in 2 decades. Even so, wages aren't keeping up with the inflation measure. Inflation-adjusted average hourly earnings fell 1.7% in January from a year earlier, marking the 10th straight decline, separate data showed on Thursday. And shelter costs, which are considered to be more structural components of the CPI, and they actually make up about 1/3 of the overall index, climbed 0.3% from the prior month. The increase reflected the biggest jump in rents of primary residences since May 2001. Owners' equivalent rent also rose. Lodging away from home fell 3.9%. That's the weakest print since April 2020, and likely reflected reduced travel amid the surge in COVID-19 infections. Housing prices are expected to offer a tailwind to inflation in coming months. Unlike wages increases, shelter is often considered a sticky component of inflation, meaning once prices rise, they're less likely to come back down. A sustained acceleration in structural categories like shelter, rather than surges in volatile CPI components such as energy, presents a much more serious threat to the central bank's inflation target. The report showed few signs that prices of merchandise are coming off the boil, while services costs are accelerating. On a year-over-year basis, goods inflation soared by 12.3% in January. That's the biggest gain since 1980, while services costs jumped 4.6%, and that's the most in 31 years. But just pause here, because these large rises are actually driven by supply chain related issues. So you have to ask the question, if you put interest rates up, will it actually improve supply chains? And if not, will this inflationary pressure continue even as higher rates strangles the economy? That's the critical dilemma that I discussed the other day with Steve Banmeter. For President Joe Biden, the decades-high inflation presents a risk to his party's razor-thin congressional margins ahead of the midterm elections later this year, and with many pointing to the White House's stimulus bill last year as a key driver of the price increases, Biden's approval ratings have taken a hit as Americans face higher prices at the gas pump and the grocery store. The Fed slashed the upper band of its target funds rate to 0.25% at the onset of the pandemic in 2020, matching the lowest level on record, and it's kept it there since to foster an economic recovery. The sea of liquidity helped boost stocks, propelling the S&P 500 to successive records through 2021 and into the first few days of January. But fears of monetary tightening has sent stocks lower this year, leaving the S&P 500 down about 5% so far. Right now, investors are not only worried about what the Fed does on interest rates, but then what impact that will have on growth. Inflation's hot, but investors will move toward looking at cash flows and what companies are going to be doing. And I think that's supportive of the markets, according to Chris Gaffney, president of World Markets at TIAA Bank. All else equal, more fuel to the inflation fire could harden the Fed's resolve to begin raising interest rates at its next meeting in March and introduce quantitative tightening in the months thereafter, said Jason Pride, Chief Investment Officer of Private Wealth at Glenmead. High energy prices and supply issues are stoking inflation, but these issues should eventually fade. Of greater concern is that wage pressures are building, and the central bank will not want to risk a wage price spiral. Looking ahead, though, real consumer spending on discretionary goods and services is likely to cool naturally as higher energy costs begin to bite, said Jay Marley, global market strategist at JP Morgan Asset Management. Overall, we remain constructive on equities over bonds, with a preference for cyclical and value stocks, commodities, and commodity-linked equities. One theme that ticks all these boxes is dividend-paying European and UK equities, which have lagged their US peers and offer the potential for catch-up gains on a total returns basis, according to John Leeper, Chief Investment Officer at Titan Asset Management. But the point I want to make is that if rates are to go up, as it looks as though they will now, that will put a dampener on things. And remember that a lot of the momentum in the economy is thanks to the excessive stimulation over the last couple of years. As that is being withdrawn, the chances of it turning negative and turning deflationary is still real. And to that extent, the more rates go up, the more likely it is that deflationary pressures will come later. Why? Because the cost of debt increases. Borrowing costs of corporates will increase. People will spend less. And the momentum, which was artificially stimulated in the first place, will ease because that stimulation is being withdrawn. Now, in that context, tell me again how equities can go higher from this point. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.